On February 10, 2026, Canadian Prime Minister Mark Carney told reporters that a disagreement with the United States over the Gordie Howe International Bridge would likely be resolved. The bridge, a $5.7 billion project expected to support over $100 billion in annual trade, remained under construction. No permits were revoked. No lanes were closed. Traffic flowed as usual. At the same time, multiple reports indicated that the administration under Donald Trump had privately raised the possibility of delaying or conditioning final approvals linked to the crossing as part of broader trade discussions. Markets did not react. Manufacturers issued no warnings. Most people never heard about it. That was understandable. The bridge was not yet open. The dispute was framed as procedural, and public statements emphasized cooperation rather than conflict. Yet for logistics firms, insurers, and cross-border manufacturers, the moment carried a different meaning. For the first time in decades, a core piece of North American trade infrastructure was discussed, not as a neutral conduit, but as a variable inside negotiation. Nothing changed that day, but something subtle may have shifted in how access is assumed. At first glance, this appears to be a narrow bilateral issue, a disagreement between allies over a single bridge, resolved through routine diplomacy. That framing misses the deeper mechanism. This is not primarily about the Gordie Howe Bridge itself. It is about what happens when access to critical infrastructure is even briefly treated as negotiable. The significance lies less in what was done than in what was signaled. Modern trade systems depend on assumptions that rarely need to be restated. One of those assumptions is that essential crossings, bridges, ports, corridors, operate above short-term political bargaining, especially among allies. Once that assumption becomes uncertain, behavior can change even without formal action. Importantly, no one needs to believe disruption is imminent. Firms do not wait for closures or delays to adapt. They respond to the possibility that access could become conditional. That response is usually quiet: additional inventory, alternative routing, legal review, higher insurance coverage. These adjustments are rational. They are also cumulative. The perception break, then, is not about conflict. It is about predictability. When predictability weakens, even slightly, systems that once optimized for efficiency begin to prioritize resilience. That trade-off does not produce headlines. It produces friction. This is why moments like this are often overlooked. Nothing breaks. Cooperation continues. And yet, the baseline assumption that connectivity is guaranteed becomes less automatic than before. This pattern can be described as the neutrality erosion cycle. The neutrality erosion cycle does not begin with disruption. It begins with optionality. When infrastructure access is discussed as leverage, even hypothetically, it introduces a new variable into long-term planning. That variable does not need to be exercised to matter. Its existence is enough. In deeply integrated systems like North America, neutrality is not enforced daily. It is embedded. Manufacturers design supply chains on the assumption that crossings remain boring, rules remain stable, and approvals follow technical timelines rather than political calendars. Those assumptions reduce costs and encourage investment. When neutrality becomes conditional, that efficiency advantage weakens. The cycle unfolds gradually. First, companies hedge. They add buffers and redundancy. Next, insurers and lenders reassess exposure, adjusting terms incrementally. Over time, investment decisions begin to favor flexibility over scale and caution over optimization. None of these steps imply crisis. Trade continues. Projects move forward. But the system begins to operate with more friction than before. This is not unique to the United States or Canada. It is a general feature of integrated economies. The difference here is context. The US-Canada corridor is one of the most mature and trusted trade relationships in the world. When neutrality is questioned in such a setting, the signal carries disproportionate weight. The neutrality erosion cycle also contains a feedback loop. As firms adapt defensively, growth can slow at the margin. Slower growth can increase political pressure to extract leverage from existing assets. That pressure, in turn, reinforces uncertainty around access. Crucially, this cycle does not require intent. It does not depend on escalation. It can persist even as leaders emphasize cooperation and resolution. What matters is repetition. If infrastructure access is treated as a negotiable element more than once, neutrality becomes something to be proven rather than assumed. And once neutrality is no longer invisible, restoring it becomes more difficult, not because trust disappears, but because planning habits change. This is why the issue matters beyond one bridge. It is about whether connectivity remains a foundation or becomes a bargaining chip. To understand why the Gordie Howe Bridge episode matters beyond a single project, it is necessary to look at the quiet systems that allow cross-border trade to function with minimal friction. These systems rarely appear in public debate because when they work, they are almost invisible. At the center is assumption. North American trade relies on the belief that certain forms of infrastructure, bridges, ports of entry, inspection regimes, operate according to technical and administrative logic rather than short-term political leverage. This belief is not written into a single treaty clause. It is embedded across thousands of private contracts, insurance models, logistics schedules, and financing agreements. The Gordie Howe Bridge sits within one of the most integrated manufacturing corridors in the world. Auto parts, machinery components, and intermediate goods cross the US-Canada border multiple times during production. Firms design these supply chains assuming that border crossings are reliable, predictable, and politically neutral. That assumption lowers costs and enables just-in-time efficiency. When the possibility emerges that access or approval could become conditional even if no action is taken, the system does not break. It adjusts. The first adjustment typically occurs in corporate risk management rather than operations. Firms do not shut factories or reroute trucks overnight. Instead, they revisit contingency plans. Inventory buffers are increased, alternative crossings are evaluated, legal teams reassess exposure to regulatory discretion. None of these steps are dramatic. All of them add cost. Financial mechanisms reinforce this adjustment. Banks and insurers price risk based not only on current conditions, but on perceived variability. If infrastructure neutrality is no longer assumed to be absolute, even temporarily, lenders may widen margins slightly or add covenants. Insurers may revise premiums or require additional documentation. These changes are incremental, but they affect thousands of transactions. Over time, those increments accumulate. Another invisible structure is capital allocation. Large manufacturers and logistics firms make investment decisions years in advance. They tend to favor environments where rules are stable enough to be ignored. When stability requires monitoring, capital becomes more selective. New investments may still occur, but firms prioritize flexibility and exit options over scale and efficiency. This dynamic does not imply capital flight. It implies caution. Projects that depend heavily on a single corridor become harder to justify compared with projects that can be distributed across regions. That shift can gradually alter regional growth patterns without any official policy change. Political constraints interact with these economic mechanisms. In the United States, border infrastructure touches multiple layers of authority: federal agencies, state governments, customs services, and international agreements. When executive-level signaling introduces uncertainty, lower-level institutions often respond by slowing decisions or seeking additional legal clarity. This is not obstruction. It is risk avoidance. On the Canadian side, similar dynamics apply. Even when leaders emphasize cooperation, planners must consider whether future access assumptions remain safe. That can encourage diversification, not as retaliation, but as prudence. Alliances add another layer. The US-Canada relationship is often described as uniquely close. Precisely because of that closeness, any suggestion that infrastructure could become a bargaining tool carries more informational weight than it would between adversaries. Allies tend to assume neutrality until shown otherwise. When that assumption weakens, even briefly, it invites contingency planning. Feedback loops can amplify these effects. As firms hedge and costs rise modestly, growth can slow at the margin. Slower growth can increase political pressure to use existing assets more strategically. That pressure can generate further signaling, reinforcing uncertainty. Importantly, none of these mechanisms require escalation. They operate quietly. Trade volumes can remain high. Official statements can remain cooperative. The system continues to function. What changes is efficiency. Invisible structures are powerful because they shape behavior without appearing coercive. When neutrality is assumed, actors optimize. When neutrality is questioned, actors insure themselves. Insurance at scale is expensive. This is the core of the issue. The Gordie Howe Bridge dispute does not signal imminent disruption. It signals that access, once treated as background, has entered the realm of negotiation. Whether that signal is repeated matters more than whether it is acted upon. If neutrality remains an exception rather than a pattern, the system may absorb it with little long-term effect. If similar signals recur, planning norms adjust. Once planning norms change, restoring the previous baseline becomes difficult, not because trust disappears, but because habits do. That is how invisible structures turn small moments into structural shifts, slowly, quietly, and often without a clear point of reversal. Escalation in this case does not begin with a decision. It begins with interpretation. In the early stage, the system absorbs the signal without visible disruption. Cross-border traffic continues. Construction timelines proceed. Public statements emphasize cooperation. The dispute around the Gordie Howe Bridge remains framed as procedural and temporary. For policymakers, this looks like successful containment. For markets, it looks like a non-event. Yet beneath the surface, expectations start to shift. Firms that rely heavily on the Detroit-Windsor corridor begin treating access as something to be monitored rather than ignored. This does not require belief in imminent disruption. It requires only the recognition that approvals and operations could, under some conditions, become part of negotiation. Risk managers adjust assumptions accordingly. Inventory buffers are modestly increased. Alternate routes are evaluated. Legal reviews become more frequent. This first phase is characterized by caution without cost visibility. The economy does not slow in a measurable way. Prices do not jump. Employment does not change. The adjustment is internal and largely invisible. As months pass, the second phase begins to take shape, not because of escalation, but because of repetition and timing. Economic decisions increasingly overlap with political calendars. Trade discussions, regulatory approvals, and public messaging begin to cluster around moments of domestic significance. Even if no new actions are taken, the context changes how signals are read. Statements that once passed unnoticed now require interpretation. Silence is no longer neutral. Timing itself becomes information. At this stage, uncertainty begins to be priced. Banks and insurers, responding to accumulated signals rather than single events, make incremental adjustments. Lending terms tighten slightly for firms with concentrated cross-border exposure. Insurance premiums reflect higher documentation and compliance costs. These changes are small and uneven, but they affect a wide base of transactions. Companies respond rationally. Projects that depend on a single corridor face higher internal hurdles. Investment committees favor designs that allow flexibility and optionality. Expansion is delayed or restructured rather than canceled. Over time, the composition of investment shifts, not away from North America entirely, but toward configurations that reduce dependence on any one crossing. This phase introduces measurable, though still modest, economic effects. Growth does not reverse. It decelerates at the margin. Efficiency gives way to resilience. The system continues to function, but with slightly more friction. The third phase emerges if uncertainty persists long enough to become part of baseline planning. At this point, firms no longer treat infrastructure neutrality as the default assumption. Instead, they incorporate access risk into standard models. This does not imply expectation of disruption. It implies acceptance that access conditions may vary depending on political context. Once this acceptance sets in, behavior stabilizes around a new equilibrium. Supply chains remain integrated, but less tightly optimized. Capital remains mobile, but more selective. Trade flows continue, but with higher overhead. The critical feature of this phase is normalization. The initial signal no longer feels exceptional. It becomes part of the environment. Decisions adapt accordingly. Political dynamics interact with this normalization. As economic outcomes become slightly more constrained, pressure grows to extract advantage from existing assets. Infrastructure, having already been discussed as leverage, appears available for strategic use. This does not require explicit action. The possibility itself influences negotiation posture. A feedback loop becomes possible. Economic caution reduces growth potential. Slower growth increases political sensitivity. Political sensitivity encourages further signaling. Signaling reinforces caution. This loop is not inevitable. It depends on repetition and context. But once established, it is difficult to unwind because no single step appears responsible for the outcome. The final phase is contingent and asymmetric. Escalation could accelerate if a symbolic threshold is crossed. If operational approvals are publicly delayed, if inspections are visibly slowed, or if infrastructure access is explicitly linked to unrelated negotiations. Such actions would force rapid reassessment by firms and markets, compressing timelines that had previously been extended. Alternatively, escalation could stall or reverse. Clear, repeated assurances, codified in procedures rather than statements, could restore the assumption of neutrality. The successful opening and operation of the bridge on schedule, accompanied by visible institutional coordination, could weaken the incentive to hedge. Over time, planning norms could gradually revert. External shocks could also interrupt the latter. A global downturn or a security crisis could temporarily reprioritize cooperation, pushing infrastructure neutrality back into the background through necessity rather than agreement. What matters most is not outcome, but path dependence. If infrastructure leverage is treated as a rare exception, the system can absorb it. If it becomes a recurring option, behavior adjusts permanently. Once adjusted, behavior does not easily revert, even if policy rhetoric changes. This is why escalation here does not resemble confrontation. There are no clear stages of conflict. Instead, there is accumulation, of caution, of contingency, of friction. By the time the effects become obvious, they are already embedded. The Gordie Howe Bridge dispute, viewed through this lens, is not a forecast of disruption. It is a test of whether neutrality remains invisible or whether it has entered the realm of strategy. That distinction over time can shape not just one corridor, but the character of integration itself. For most people, border infrastructure feels distant. Bridges, customs procedures, and trade corridors are rarely part of daily conversation. Yet when uncertainty enters those systems, its effects tend to surface quietly in ordinary life. For middle-class households, the impact is most often felt through gradual cost changes rather than sudden shocks. Goods that rely on cross-border supply chains, cars, appliances, home repairs, may become slightly more expensive over time as companies absorb higher logistics and insurance costs. These increases are rarely dramatic, but they can be persistent. At the same time, employers exposed to trade corridors may delay raises or promotions as they reassess long-term plans, making financial progress feel slower even when jobs remain secure. For retirees, the issue is less about volatility and more about predictability. Fixed incomes leave little room to absorb steady price increases. When everyday costs rise slowly but consistently, savings last less than expected. Investment portfolios may also face reinvestment risk if markets price in higher uncertainty around growth and trade, requiring more careful monitoring at a stage of life when flexibility is limited. Small businesses tend to experience the pressure earlier and more directly. Unlike large firms, they have fewer resources to diversify routes or absorb delays. Even minor border friction can raise shipping costs, slow deliveries, or complicate compliance. Owners often respond by staying lean, postponing hiring, delaying expansion, or reducing risk. For many, the business itself represents long-term security. When uncertainty persists, that security feels less dependable. For future workers under 30, the effects are the most delayed but potentially the most consequential. Entry-level hiring is often the first area where caution appears. Fewer openings today can shape career trajectories for years. Slower regional investment can also affect housing affordability and wage growth, making it harder to build stability early in adult life. The loss here is not immediate income, but opportunity. Across these groups, the common experience is not fear, but hesitation. Decisions become more cautious. Plans are made with shorter horizons. Over time, that collective caution can reshape economic outcomes without ever producing a clear moment of crisis. Nothing in this story points to an imminent breakdown. Trade continues. Trucks cross the border. The bridge moves toward completion. From the outside, the system appears intact. The uncertainty lies elsewhere, in what people begin to assume. Economic systems rely heavily on what does not need to be negotiated. When access to essential infrastructure is taken for granted, decisions are faster, bolder, and more efficient. When that access becomes something to be monitored, even hypothetically, behavior changes. Not because rules have changed, but because the confidence surrounding them has. The risk is not that neutrality disappears overnight. It is that neutrality becomes conditional enough that it must be priced, hedged, and planned around. Once that happens, efficiency gives way to caution. Growth continues, but with less momentum. Integration persists, but with more friction. History suggests that trust in systems is easiest to preserve when it remains invisible. Once it becomes a topic of discussion, restoring the previous baseline can take time. Not because anyone acted in bad faith, but because habits adapt faster than assumptions recover. The open question, then, is not about one bridge or one negotiation. It is whether critical connectivity will continue to sit above bargaining or whether it slowly becomes part of it. If neutrality is reaffirmed through consistent practice, the system may absorb this episode with limited long-term effect. If similar signals recur, planning norms may adjust in ways that are difficult to reverse. These changes rarely announce themselves. They accumulate quietly through small decisions made for sensible reasons. If you want to understand how economic shifts often begin before they become visible, this is where attention matters, not to predict outcomes, but to recognize when assumptions start to move. That awareness is not about alarm. It is about noticing change while it is still subtle.